So look, a bit of context. We've been going for 3.5 years. We started from scratch post the GFC and National Consumer Credit Protection Act. So we came into the market when it was fairly mature, but we came in with a proposition that was quite unique. We're not an aggregator pure, or we're not a franchised branded business pure. We're a hybrid model. We have a retail branded proposition in the marketplace. And so we recognise that if we come into the market late, we're not going to build scale, which is in some cases what you need to make money in distribution. We make our money from product margin, that is the business that our advisors write through Liberty. So looking at our proposition and looking at how we build this business, we had to be very clear on our proposition and very clear on what we offer that is different to the market, because that way you can obviously then grow the network and be successful. We're about to reach 80 advisors in the network, and we're targeting to hit 100 in this financial year, so by June next year. Which is, given that we are late entering the market, getting to 100 advisors within a sort of 3.5 year period is no mean feat, and we're very excited and encouraged by that. I guess challenges have been largely quality of the broker market out there. There's obviously those that are established, they write good volume, that will remain with the current aggregator that they're at. But there's many brokers out there that are sitting at the 1 and 1.5 million in settlement volume per month, that largely, given the new world of digital and given the rapid changes that are taking place, as we know, are looking for homes where they can get support, genuine support. So I wouldn't say it's a challenge, it's actually been an opportunity for us to identify and target those particular operators out there so they can look at joining someone that can give them the support. The challenge has been, of course, to get them to understand what it is we're about. In the early days, we were largely seen as an extension of Liberty as a lender, and of course most people have associated Liberty with custom lending or non-conforming lending, which of course Liberty is not. Liberty is a lot broader than that. We now have a broad prime range of business, obviously benefiting from the investment market at the moment. So 50% of Liberty as a lender's flow comes through prime business, and 50% comes through what is called non-conforming. So Liberty has a wide range of products. It's also very big in motor lending. It's fairly big in commercial lending, and it's got a very unique position in terms of self-managed super fund lending. In addition to that, we've recently engaged with LFI in terms of the insurance side. So looking at Liberty as a lender, it's a broad proposition, but in the marketplace with brokers, they've, until recently, tended to associate Liberty Network Services with an extension of Liberty, and all you're going to write as a broker is Liberty Business. Well, that's not the case at all. We've overcome that, and we're overcoming that more and more as we become more known and recognised in the market. So Liberty Network Services really has the best of both worlds in that, yes, our Liberty advisors, traders Liberty advisor, would write a proportion of business through Liberty, but equally they've got a panel of 18 lenders, and they can write business through those 18 lenders. They're not obligated in any form or fashion to write anything through Liberty, but clearly given the service, the product and the support that we provide from Liberty, they tend to write some business through Liberty. It's no difference to a choice lend, plan lend, a fast lend in the NAB group, where they tend to write some business through those particular white label products. So we've overcome that challenge, and that's taken, I guess, the first 2 years, the early years of kind of bedding down the business. You had to kind of get that in place. Equally, our technology platform, we made a very clear, conscious decision that we need to leapfrog the market. And so we went out 3 years ago with a platform that was built off the iPad. It was a pretty brave move. It took us the first year to really bed that all down. So basically, unlike many providers who provide CRM solutioning off the iPad or off tablet, we provide the end-to-end solution. So we won the Innovation of the Year award 2-3 years ago when we first came out. We've been up a few times in terms of finalists with yourselves. But certainly our advisors can go into dealing with a customer in their home or at the office on the iPad and process a loan from end to end through to NextGen, through to a lender using the iPad. Customers can sign on it, they can take photos. It's really cool, it's progressive, it's really good. Now obviously the window's closing because more and more of the major banks and others are looking to move a lot of their platforms onto the mobile devices. But certainly we've been there for 3 years. We've learnt a lot in terms of behaviour, in terms of how the advisors embrace that. So from an advisor perspective, They love the technology that's there. So again, from a challenge point of view, it's really getting our proposition in front of as many people as possible. Once they understand what we do, they're pleasantly surprised. And of course, then they want to engage with what we have to offer. Our economics is also very good. From a brand perspective, in terms of economics, we have a very sharp pricing model. So we pay our advisors handsomely. We don't take much of the commission from them, simply because our model is to make money on the margin on products they write with Liberty. So the good news is Liberty commands around 30% share of all flow to our business. So effectively, Liberty is the number one lender on our panel of 18 lenders, ANZ being the number 2 lender on the panel. So I guess in some ways it's proven that it can be done. You know, just because there's the big aggregators out there and there's the big 4 and most brokers write business through there. And Liberty would typically sit anywhere between 12 and 15 on the lender panels of aggregators out there. In our instance, it's the number 1 lender, which goes to show that in fact, and with 80 advisors, they can't be wrong, that in fact Liberty has the wherewithal to be able to provide services across the board, not just with non-conforming, but with residential, motor, etc. The other benefit we've had is we've recruited mortgage brokers in, and we've converted those mortgage brokers to Liberty advisors, and they now write motor. So 68% of our advisors now settle motor loans every month, which is significant. I don't think any other mortgage broking business out there can claim that. So that's significant. And of course, that's a slightly different behaviour, a different way to engage with customers, because it's a very emotive buy. It happens within 24 to 48 hours. And so we've had to, in terms of challenges, sort of re-educate the mortgage brokers on how to kind of adapt to that type of asset class lend moving forward. But they've embraced that and done it well. The other exciting component of our business is insurance. We now have a conversion rate of 22%, which is high. You know, the industry, I think, is kind of well below 10%. So again, because we've built all this into our platform, because we don't have any legacy, it's so easy to actually navigate through that. So yeah, so we're kind of sitting at 80 advisors. We're growing to around 100. Our volumes are following suit very quickly. The flow to Liberty is good. We made some good profits in the last financial year. You know, we broke even after the first 14 months, so that's kind of unheard of in this industry. And of course, we're just going from strength to strength. Obviously, we all know the nature of the APRA regulator and what they've done in terms of balance sheet and of course growth and limiting it to 10%. And also equally a bit of moral suasion in terms of, you know, enforcing not enforcing, but certainly looking to the banks to try and curtail at 80% LVR. So you kind of got those two levers at play, which obviously has put a lot of pressure on the banks, which they've responded to. And of course, not just the banks, but second tier banks and the smaller banks around the country. They've all had to respond to that under the regulatory rule. Which I guess is important and necessary given the nature of where the industry and the market is at. That said, the investment market itself, I don't believe is going to come off significantly. It will obviously slow, but the reality is you can't stop foreign investors coming into the country. They will keep coming, significant foreign investment. And there's people have got a love for property, so irrespective, they'll still see property as a good way to grow asset, a good way to diversify your portfolio. And so investments in property investment will continue. That said, therefore, there's a need to have lenders out there who can obviously meet the demand. And certainly from a Liberty point of view, we're ready and set to do that and obviously navigate through that. We've got to be careful that we manage our service levels and our expectations. And that we manage the growth in that particular category, because obviously we've got a wide range of asset classes and we want to grow a good balanced book as Liberty. So we've got to be careful around how we grow our investment portfolio, but certainly we're open for business. And you know, there's always winners and losers in times of change, and right now in the short term, we're certainly there to write more business, and our rates are very favourable relative to all the majors. In fact, I think in some cases we will be cheaper than the majors, which, you know, if you go back 5 years ago and said to someone that Liberty would have a cheaper rate than the majors, it would be unheard of. So that's how the world changes. So we're excited about the change.